Hi, I'm Jeff Permet, one of the portfolio managers for the Nexus Dynamic and Solutions portfolios. So August proved to be one of the most dramatic and volatile months in the financial markets that we have seen so far in 2024. Markets were selling off towards the tail end of July, particularly tech names, and there were growing concerns that the US was perhaps heading for recession and that the Fed had kept rates too high for too long. And in fact, the labor market data released in early August seemed to certify that that in fact was the case, and it produced a really dramatic panic in equity markets in early August. For example, the Nikkei 225, which is the third largest equity market by market capitalization, dropped by over 25% in the space of about 3 trading days. Unprecedented volatility. And this also spilled over into the US markets, particularly many of the big tech names that have been such a success for investors this year also suffered large drawdowns, not 25%, but significant drawdowns early in August.
In terms of the portfolio, we saw a mix of returns across the board, and generally the solutions was relatively flat in returns this month, and dynamic, again, relatively flat in terms of return, reflecting the mixed month we've had through August. The areas where we saw more positive returns were in more of the defensive stocks, the Coca-Colas of this world and the United Healths, and while some of the tech names lagged in terms of performance, some of the more key names such as Meta actually have still continued to provide strong returns.
We, as portfolio managers, did not overreact to this situation at all. So we really didn't take any specific action in the funds to counter these sell-offs. And that proved to be correct, as over the course of August, some additional US economic data was released that reduced some of the fears about an upcoming US recession. And then at nearly the last point in the month, Chairman Powell, when he was speaking at the Jackson Hole conference in Wyoming, announced that it was time for a change in the direction of US policy. So he's suggesting probably strong action by the Federal Reserve to bring down US interest rates to mitigate weakness in the labor market.
The ECB was cut rates prior to the Fed, but the Bank of England has remained more reticent in terms of its approach. So this led to one of the factors we saw towards the end of the month, with sterling actually rallying against the dollar. So whilst we did see that rally at the end of the month in many of the tech names, which we've held in the portfolio, the impact of the strength of sterling against the dollar hasn't really helped us, for those of us who are sterling-based investors.
Going forward, we would expect to see rate cuts by the Bank of England and the ECB over the balance of this year and certainly early into next year, as inflation has also come back down nearly to their targets. But the Fed may initially be seen as more aggressive, and that may suggest future dollar weakness in the near term ahead. And it's something that Nick and I are focusing on and will, if necessary, take actions in the portfolio to mitigate that. With the US election now less than 70 days away, I think it's worth thinking about the prospect of Kamala Harris' government. She is now the candidate for the Democratic Party. Her polling numbers have risen to the point that she is now ahead of Donald Trump in some of the national polls and in some of the so-called swing states. Harris's optimism is outweighing Trump's negative views, and that the election may swing to her. Turning here to the UK, the new Labour government has so far been vague on what they're going to do economically. They have warned us the next few years may be painful. We are going to get a budget from Chancellor of the Exchequer Reeves on October 30th. While the budget may sound harsh and troublesome, it's unlikely that they can raise significant revenue and have a dramatically negative impact on the UK economy. Obviously, we'll have to wait and see, but I think the one thing that stands out is they're clearly targeting what they deem as the wealthy, and they look at capital gains tax as the best way to achieve that.